Critical to the New York Fed's governance structure is its board of directors. The board is composed of 9 members and includes representatives from the business community, banks, and labor and consumer organizations. Directors cannot be members of Congress and may not participate in certain partisan political activities such as holding a leadership position in a partisan political campaign or serving on a fundraising or campaign committee. The role of the directors is to advise the Reserve Bank president about economic, community, and business developments in the district, and to ensure that the bank is a well-governed and well-managed institution. The members are divided into 3 groups, or classes, of 3 directors each. Class A directors are elected by and serve as representatives of stockholding banks. 3 groups of member banks, representing small, medium, and large banks, each choose one of the 3 directors in Class A. Class B directors, also elected by member banks, represent public interests in agriculture, commerce, industry, services, and labor. They may not be officers, directors, or employees of any bank. Class C directors are designated by the Board of Governors of the Federal Reserve System. Like Class B directors, they may not be officers, directors, or employees of any bank. In addition, they must have been residents of the 2nd District for at least 2 years and may not own stock in any bank. One Class C director will be appointed by the Board of Governors to act as the board chair. Another will be appointed as deputy chair. The Federal Reserve Act empowers the Class B and C members of the Board of Directors to appoint the bank's president and first vice president. In addition, the board serves 3 important functions. First, gathering economic intelligence. Directors are the bank's eyes, ears, and voice in the district, acting as a link between the Federal Reserve and the private sector, with information flowing in both directions. The conversations they hold, the stories they hear, and the questions they encounter inform the bank's monetary policy process and help us fulfill our long-term mission. Second, exercising corporate governance. The bank relies on the oversight of our directors to ensure we're meeting our responsibilities. In addition to overseeing the bank's budget, expenditures, and performance, directors are also responsible for the internal audit program of the bank. Third, establishing the discount rate. Once every 14 days, the board of directors in each district votes to set the discount rate, the rate financial institutions pay when borrowing funds from the Fed. This rate is subject to review and approval by the Board of Governors.